Money, money, money. Something we all want, something we all need. What we're going to talk about today is what you do in investing that money, the excess money you have, with the idea that you can use it down the road. Maybe it's retirement, maybe it's cash flow, maybe it's for other expenses, going to college, as one of my other presentations shows, but it's to use excess money now for the future. What can we do with that to make it worth our while? Money. We want it. We need it. Let's invest it wisely. Let's look at why it's a good idea to buy real estate. That's what this whole presentation is about. Only we're going to tie it to the Great Falls market. Why is it a good idea to invest in real estate in Great Falls? The Great Falls market right now is very good and primed for an investor to really do well in Great Falls real estate. Why? One, it is harder for people to qualify to buy for a house. Because of the 2008 recession, the banks lending tightened up a lot. Whereas it used to be easier to get into a house with virtually no money down, today people need down payments. Plus they need good credit. That's not as easy as it used to be. When you have someone who can't get a loan to buy a house because of their credit or because of their lower income than they can afford, they have to rent. What is interesting is it's cheaper to own than to rent in Great Falls. A typical house in Great Falls will rent for more than the typical house loan payment for that same house. That's why it's a good investment opportunity for you, the real estate investor. There are three kinds of investors, level of knowledge, that you will find out there. There is the novice. This is the first or second opportunity you've looked at. There is the intermediate. You've invested 2, 3, 4 times. You're fairly comfortable, but you're not quite there. And there's the expert. The expert has done a lot of investing, feels really comfortable, and knows what he's doing or she's doing. This presentation is designed for the novice investor, the person who's never invested, or maybe this is their first or second investment that they would consider. A little bit for the intermediate investor. This is a good refresher course as to why you are investing. Who am I to tell you how to invest? My name is Pat Goodover. I've been a licensed real estate agent since 1978. I am a current active investor. We own rental houses. We own commercial properties. We own non-house investments as well. I'm currently involved in buying property, fixing it up, and selling it. And I have an accounting degree, which really shows me how to analyze an investment to see if it's a good financial risk, if it's a good investment opportunity. That's what I want to help you with. How much do you have to invest in real estate? For that matter, how much do you have to invest in anything? I'm going to propose a dollar amount in the $20,000 to $25,000 range, and for purposes of examples, I'm going to use $24,000. I'm going to suggest a 15-year time frame. You may be interested in longer, you may be interested in shorter. 15 years is a good time frame for most investors, and the program I'm going to show you will show you how you will end up free and clear with property in 15 years. So let's see what we can do with $24,000. In order to do that, we need to compare apples to apples. So we need to see, what does $24,000 do in 3 or 4 different scenarios. Where can you invest this money? You can put it in the stock market or bonds. You can put it in annuities, or you can put it in real estate. Now there are lots of other options that you can utilize: gold, silver, precious metals of other kinds, all sorts of options, oil and gas. But these are the three that I'm going to throw out to use as comparison. Stocks and bonds, annuities, and real estate. They have similar things in common. They have things that are not in common. Let's put our $24,000 into the stock market. If you talk to a stockbroker, he or she will tell you that it's realistic to expect about a 10% annual compounded return on your invested dollar over time. The last 15 years, it has been roughly 8%. That has included a major and a minor recession. So for the sake of argument, let's use 10%. We're going to put it in for 15 years, and at the end of 15 years, that $24,000 will have grown to $71,000 after taxes. And here we are guessing what taxes are. I'm using 25% as the tax bracket. I'll explain that in a minute. What are taxes? We have no clue what they will be in 15 years. When you invest in anything, you have to take into account the taxes as they are when you invest them, because we don't know what they'll be down the road. Today, the capital gains rate in 2014 is 20% for the federal taxes, and let's assume around 5% for state. That's where we come up with 25% as the tax rate to utilize in these analyses. Let's consider an annuity. An annuity is where you put a constant dollar amount into an account, assuming an annual return for a set time frame. It doesn't have to be an annuity by name. Putting money into the stock market annually, the same dollar amount over the same time frame, is an annuity. Putting money into the stock market monthly is an annuity. Putting money into your retirement fund, whatever kind it is an annuity. So an annuity can be a number of different things, even though it may not be called an annuity. What we're looking at is how do you calculate the return on investment. How much do we need to put in per month or per year in order to end up with $71,000 15 years from now, allowing for a 10% annual compounded return on your investment? The answer is $2,300 per year, which is $34,500 total over the 15-year time frame that you're going to be investing, allowing for a 10% annual return over 15 years to end up with $71,000. We can do a lump sum annuity. That's where you put a lump sum into an annuity and let it sit for 15 years. That is exactly the same calculation as we did with the stock market to begin with. In the lump sum annuity, we will put $24,000 in, assume a 10% return on investment over 15 years, ending up with $71,000. Here is a chart comparing those three investment opportunities, allowing for a 10% return after taxes. You have the stock market and the one-time lump sum annuity, both of which require $24,000, ending up with $71,000. Or you have 15 payments of $2,300 per year, or $34,500 over the life of the 15 years, ending up with $71,000 after taxes at 10%. Why am I showing you these investment options when I'm trying to talk to you about real estate investments? Because I want to show you what the traditional safe or sort of safe investment mechanisms get you. What does $24,000 give you at the end of the day, 15 years from now, allowing for a fairly safe and conservative investment opportunity? And how does that compare to real estate? What about real estate? What can we do with a real estate investment? Let's use the same figures we had before. $24,000 is our investment. We're going to use that to purchase a $120,000 rental property. We're going to get a loan at 5% for 30 years. Or we're going to utilize that loan program to make it better for us. That is a typical interest rate and loan program available for you as an investor today as I'm recording this presentation. So let's look at real estate. Let's put our $24,000 down. We're going to purchase a $120,000 piece of real estate. That is a 20% down payment. We're going to assume the same 10% return on investment, which really means it's going to increase in value 10% per year for 15 years. I do not expect that real estate will increase in value at a constant 10% return for 15 years. But to compare apples to apples, we're going to pretend it will. At the end of 15 years, your $24,000 investment will turn into $501,000, a little over $500,000 from a $24,000 out-of-pocket investment. Now can you see how important and beneficial real estate is as an investment compared with the other options? As I said, I do not expect real estate to increase in value 10% per year constantly over 15 years. It might in any given year, but I doubt seriously it will do so over 15 years. So let's take these same figures and allow for a 5% return. What does a 5% increase in value over 15 years yield for this $120,000 piece of property? And the answer is it will increase in value to approximately $249,000. You will have taken a $24,000 investment and converted it to about a $249,000 investment. That is a tenfold increase in value. Pretty darn good. Are those figures realistic? Can you realistically expect real estate to increase in value 10% per year or even 5% per year? 15 years ago, the median priced house in Great Falls was approximately $80,000. Today, that house is approximately $166,000. That is a typical Riverview house. So effectively, it has doubled in value over 15 years. I have a disclosure my attorney has asked me to read to you. It says, nothing here is intended to guarantee any return on your investment. We cannot guarantee future profits on any real estate investment. What you see here is just math. Let's talk about loan payments. If you are going to purchase a property as an investment, you're going to probably want as much debt as possible and as little money of your own involved. Right now the lenders are requiring about 20% down, so that's how I'm analyzing these figures. For a $100,000 loan at 5% for 30 years, your principal and interest payment is $536.82. Adding taxes and insurance, your total house payment will be $686.82, or just about $700. If you were to pay this off over a 15-year level payment plan, your principal and interest amount will be $790.79. Allowing the same dollar amount for taxes and insurance, you are at $940.79, or roughly $1,000 a month for your house payment. If instead you take this 30-year loan and pay it in 15 years, as I'm going to suggest you do, your house payment will be significantly less. Your principal and interest will be $666.82. Allowing for taxes and insurance, your payment is roughly $810, allowing for $825 as your total house payment. So how do you take a 30-year loan and pay it off in 15 years like this? This is a $100,000 loan at 5% over 30 years. In January, you are going to take and pay your normal house payment of $536.82. In addition, in January, you will pay your next month's principal portion of the loan, in this example $120.65. You will pay both dollar amounts in January. Then come February, you will pay your normal house payment of $536.82, plus you will add to it the next month's principal portion of the loan, which in this example is $121.66. You will pay these figures both in February. Over time, if you continue doing this, you will take this 30-year loan and pay it off in half the time. Each month, you will pay a little bit more in principal, in this example $1.01, between the February principal portion and the April principal portion. It will increase slightly each month, but over the 15-year time frame, if you pay your house payments on this schedule, you will pay your loan in half the time. Here is a chart showing loan payments and cash flow. Using a straight 30-year loan payment, your payment is $536.82 plus taxes and insurance, or roughly $700 per month. Allowing for a rental of $1,000 per month, which in today's market is realistic for a $120,000 house, you will have a $300 per month net income. If you pay this on a 15-year loan at $1,000 per month with $1,000 rent, you will pretty much break even. If you will pay it on a 30-year loan paid in 15 years, as I proposed, you will take and have $1,000 a month rent, an $825 a month house payment, or about a $175 per month net income. The best advice I can give you as an investor: structure the financing to benefit you, not the bank. Structure it so that it helps you invest and become a better investor. Let's look at that same chart that we had before, only this time put in a real estate investment so we can compare how it looks as relates to the other investment opportunities. We have a $120,000 real estate investment that we're going to purchase with $24,000 down. If it increases in value at 10% per year, and I know that it will not, but if it will, you will end up with a $500,000 piece of property, whereas with the other investments you will have a $71,000 end result value. Let's use a more realistic 5% return on our invested dollar. If we do that, that $24,000 investment in real estate will yield $249,000 at the end of the day in 15 years, compared with the stock market or an annuity, which will end up at $71,000. That is quite a significant difference. So being conservative with a 5% increase in value per year over 15 years, what this means is your tenants will be paying off your investment property over the 15 years, giving you whatever use you want of that money or that property once it's paid off in 15 years. you will have taken a $24,000 investment and with the help of your tenants converted it into a $249,000 asset. There are 4 benefits of owning real estate. Theoretically, it should increase in value. The government allows you to pretend on your taxes that it decreases in value. There should be a cash flow to any investment, and over time you will pay your loan payment down, so the loan balance goes down ever so slightly in the beginning years and more as you get closer to paying it off. Let's look at this $120,000 investment purchase and analyze it based on those 4 benefits of owning real estate. As you can guess, that house is not a $120,000 house, but it serves to illustrate how you break it down to analyze it. Let's allow for a 5% appreciation rate, which is conservative but doable. Let's depreciate this property out in a very conservative manner. We're going to allow $20,000 for the ground and $100,000 for the real estate. The $20,000 is not depreciable, the $100,000 is. Under current tax law, you can depreciate that $100,000 straight line over just under 30 years, 29.5 years. So for our methods and our math calculations, we are going to use 30 years. For the cash flow, let's use the example I gave earlier of $175 per month. That's where you have a $100,000 loan payable at 30 years over 15, structured the way we did. Using that same example, we're going to use the decrease in the loan balance. This $120,000 purchase will therefore have approximately a $6,000 increase in value, a $3,000 decrease in value, a cash flow of roughly $2,100 per year, and a decrease in the loan balance of roughly $3,000 per year. So taking this $120,000 purchase and combining all of those returns, your total return on that $24,000 investment is $14,100, which divided by your actual out-of-pocket invested amount, $24,000, is a 58.8% return on your invested dollar in the first year. One more disclaimer. I am not an attorney. I am not an accountant. I do have a bachelor's degree in accounting, however, but I don't practice that profession. I am not a financial planner. I am just an investor like you. Only I started 30 years ago, and I want you to start now if you haven't already done so. How do you get the money out of an investment? There are 3 ways. 1, you sell it. You pay your capital gains taxes and any other taxes you want, but you sell it. There is a way to not pay taxes under current tax law, in which you exchange that property for another one. You keep trading up and up, or level and level, and eventually it gets cashed out. But that's beyond the scope of this discussion. 2, you refinance it. Under today's tax law, refinanced money is tax-free. You don't pay taxes on it. There's a little catch in there that if you were selling it afterwards, you would have to pay tax on any gain, even if you got it out of a refinance. But the refinanced money itself is not taxed, which means you can use it to purchase another property. You can always keep it. If you've paid this off in 15 years, you have a house with, in today's dollars, $1,000 per month coming in, and no loan payment going out. Now, $1,000 a month in today's dollars can be a nice benefit in your retirement when you're ready to retire. It's a much better deal if you have 4 houses, because $4,000 a month in today's dollars is a very nice addition to any other retirement funds you may have. A common question I hear is this: I'm not going to be here for very long. I'm only going to be here for 1 year, 2 years, 3 years, a short time. Why should I buy a house as an investment? And the answer is, it really doesn't matter where you buy the house. It matters that you buy the house. If you buy a house here in Great Falls and it increases in value at 5% per year for 15 years, it's the same as if you bought the same house or a similar house in Bozeman, Missoula, or Orlando, Florida. It matters that you do it, not where you do it. We have property managers here who can look after your investment. If you buy a house and live in it, it's your first house or it's a new house for you to live in, it is easier to purchase and structure as an investment property. It is cheaper to purchase that. You only need 3.5% to 5% down for FHA or conventional, or 0% for VA, instead of a 20% down payment. The interest rate is slightly lower, could be 1 or 2% lower, which makes a huge difference over the 30-year time frame of that loan. It works regardless of whether you own it to live in it or own it as an investment property, because once you move out of this house that you've purchased to live in, it becomes an investment property. If you invest in real estate, I guarantee you that over time you will have a bad tenant. I can also guarantee you that you will have a good tenant. Hopefully more good tenants than bad. Over time you will have repairs and maintenance. You will also have a vacancy, even if it's just the time it takes for one tenant to move out and a new one to move in. But that is lost income. Budget for it. Plan on it. It will happen. That cash flow that you were looking at of $175 per month, keep it. Don't spend it. There are typically 3 excuses I hear as to why I don't want to get involved in real estate. The first one is, I wouldn't want to live in a $120,000 house. And the answer to that is don't. But a tenant will be thrilled to live in a house they can afford that is in good shape. And I'm not going to show you houses that are run-down junkers. You will be looking at houses that are in good condition as far as we can tell. You are buying it as an investment. You are not buying it to live in it. The second thing I hear is this: I could have bought that house 20 years ago for X amount of dollars. That's probably true. When I first started in real estate, Riverview houses were selling for $45,000. Today, those same houses are $165,000. What will they be worth in 15 years? And then the final comment that I hear is this: if it's so good, why don't you do it? Well, as I said earlier, I have done it. Over the 30 years that I've been investing, I've invested in every kind of real estate you might think of, other than bare land. I've bought income property, I've bought houses to live in. I've done it, and I know you can do it, but you may need some help. Because I have done it, I know how to help you invest in real estate so that you can have a decent retirement income, if that is your goal, in 15 years or more. And finally, what I hear is this. Aren't you competing with me, Pat? Well, no, really, I'm not. There's way too much available for any one person. The market is wide open if you know what you're doing and you buy good investment properties. There are certainly more investors in Great Falls than I am, and we have all the properties we want, need, or desire. I want you to become the next future investor. So let me help you. Now, even with all this presentation I've done, if you're a first-time investor or an earlier investor, it's very common for you to say, I'm scared, I'm nervous about this, I'm not really comfortable because what if, and what if? So, here's my guarantee to you. If you buy and you want out, I will buy it back from you in the first year. Now, obviously, I've got some details. Just ask me for them. So, if you are concerned about getting into something and then not feeling comfortable after you've gotten into it, I will get you out of it as quickly and easily as I want. I'm betting you will decide this is not what you want. You're not willing to get rid of this good investment property that I've shown you and helped you buy. But if you do want out, I will take care of you as much as I can. My guarantee to you, if you buy and you want out, I will buy it back from you. Even if you're working with another realtor, that person won't give you this guarantee. I will. Because I'm confident that what I get you involved with, you're going to come back and say, I want another one. I want more. And you're going to give referrals out saying how well you were treated and handled. That's why I feel comfortable making this guarantee to you. Are you ready to do this? Are you ready to get involved in investing in real estate in Great Falls? You need someone who understands why you are investing to make it work. Any guesses who that might be? Obviously, I put this presentation for me. That is my name. That is my real estate office. It is a real estate brokerage. That is my phone number here at the office. That is my cell number. I can also receive texts on it. This is how I work. I've located many properties that can work for you with this program. We will need to limit it to about 3 houses for your first investment. You do not want to look at the whole market. You want to look at really good investment opportunities for you to consider. I will arrange to look at these properties. You decide which one works best for you. I will then give you an analysis and breakdown of how that particular property would work for you. How you work is as follows. You decide how ready you are to buy. There are 4 kinds of people watching this presentation right now. One of them, I want to do this. I am ready to arrange for my retirement and my future income as inexpensively and quickly as possible. The sooner the better. I need you to get a hold of me as soon as you can. The second one, this is a really neat idea. I want to do this, but I need to check with somebody else, my bank, my spouse, somebody else before I do it. That's fine. Once you're ready to invest, get a hold of me. All right, let's consider it. Let's admit it. Some of you are here just to see what I'm selling. How have I got this thing structured? Well, I'm not selling anything. I want to help you invest in real estate so that you are better off down the road than you will be without it. And fourth, there's a group of you that says, I have a realtor. Even though he or she doesn't know what the heck I'm talking about, I will have that person help me and I will take my chances. That's okay, because the second time you buy will probably be from me. There are some required state forms that you should see when you talk to a real estate agent. They are nothing more than a definition sheet. They explain how real estate agents can behave in the state of Montana and how that affects you. It states in there that the agent can represent the buyer, the seller, both, or neither. There are duties attributable to each type of representation. I need to represent you as much as possible because I am a buyer's agent whenever possible. I have another video presentation called Don't Tell Me That in the YouTube video program that gives you a much better explanation as to why this is important. I would ask you to take a look at that as well as finishing up this video here. Alright, it's action time. Let's see what we can do. Well, you can do something or you can do nothing. If you do nothing, nothing will get done until you do something. I can't help you unless you let me help you. Please do one of the following. Call or text me. The red phone number is my office. The green one is my cell. I can receive texts on my cell. Email me at goodover@centric.net. If you're interested in getting involved in buying investment real estate, put in the email title Investment Real Estate. If you want to give me feedback or ask questions, put in the email title Feedback or Questions. Please do something. This is my name. This is my office phone number. This is my cell number. This is my email address, goodover@centric.net. Please note it's .net, not .com. Thank you for watching my video presentation on how to invest in real estate in Great Falls. Please connect with me. Let me help you start on your process to, if you want to call it this, financial independence, or at least a good retirement program.